Bloomberg Audio Studios. Podcasts, radio, news.
I want to now bring in our Bloomberg TV and radio audiences worldwide. We're going to simulcast this. Joining us now is White House Council of Economic Advisors Chairman Stephen Miran. Stephen, thanks very much for joining us. We were just listening to David Kostin of Goldman Sachs giving an optimistic view of the stock market and the way companies are dealing with tariffs. And I wonder how you think about the uncertainty that this creates. You definitely must have calculated that in coming up with this strategy. And if we're going to see an end to that uncertainty come August 1st.
Good morning. Thanks for having me. Look, I do see the uncertainty starting to reduce in the near term. Part of the benefit of uncertainty is it gives us leverage in negotiations, right? Like the president knows how to extract concessions from our trading partners, and he has been very successfully doing so. Now, as what you've seen with a number of these letters is there's some countries that haven't made the concessions that the United States requires, and as a result of the decades of accumulated trade deficits, the president has decided that tariff rates should ratchet back up for those countries on effective August 1st, and I expect that to happen.
I want to talk more about the sectoral tariffs, the Section 232. You look at copper just over the last 24 hours and the price increase you've seen in copper alone. This is a critical input for data centers, for power grids, for industrial machinery. And as the administration looks to bring more manufacturing onshore, how isn't it the case that a 50% tariff would impact some of those other efforts to otherwise power the economy?
So you have to differentiate between changes in relative prices and changes in the general price level. And when you target a specific good with a tariff like copper or some other specific good, you're going to get relative price changes, and that's totally expected. But that doesn't mean that there's an increase in the general price level, by which we mean inflation, because there are lots of thousands of products and services that go into the general price level, and it's an average, a weighted average across all of those. And we just published research yesterday showing that there has been no tariff-induced inflation in a general price level since the tariffs began being implemented in January. Quite to the contrary of all of the Cassandras that were shouting that it was going to be extremely inflationary. There's just no evidence of that thus far, just
Stephen,
like in 2018, 2019. Yeah.
Listen, I read the research, and we'll get back to it, but on copper, I want to read this note from Jefferies. They say that the U.S. does not have nearly enough mine smelter refinery capacity to be self-sufficient in copper. So then why target it?
Well, we need more of it. We need more of it produced domestically. There are certain critical minerals, of which copper is one, that you just absolutely need if you're going to have a manufacturing sector. And having a manufacturing sector is important, not just economically, because it tends to be a high capital, high productivity field with good paying jobs, but also for national security. You cannot defend yourselves if you do not have a robust manufacturing sector, and critical minerals like copper are essential to that. So will we be able to corner a market in copper? Absolutely not. But can we make more than we currently do? Yes.
So how long will that take? I mean, for example, when will these copper tariffs go into effect? Or is this just a stick rather than a carrot that you use to try and motivate the industry?
No, well, the president said we're going to do copper tariffs, and I think the president, and I think the president follows through on his promises. So I would expect them to happen. I don't have a date for that happening. Yeah. Well, I don't have a date for that happening. That process is underway.
All right. I want to ask also about the first point that you made, using tariffs not necessarily as a revenue raiser, but as leverage in discussions. I've watched Japan tariff U.S. automakers for decades now, and they refuse to back down. Are you going to be able to extract that kind of concession from such a stubborn economy?
Look, I think that the president is one of the best negotiators in history. I mean, he's spent decades negotiating deals across every field, from commercial real estate to international trade, and I have no doubt that he can negotiate successfully now too. But in order to negotiate successfully, other countries have to know that you're serious and that you're willing to do what it takes to get there, and that's what these letters show, that we are absolutely serious. So I hope that a country like Japan comes to its senses and does make the concessions they need, because it'll be better for them if they do.
Stephen, I do want to go back to your report, and I do appreciate the reports that have been coming out of the Council of Economic Advisors. I have been reading all of it. On the most recent report on the imported goods inflation, what do you say to the people that are looking at the impact of energy prices? Because if you subtract petroleum, you're not getting the same impact. In fact, you're seeing the price of goods rising in many categories that matter to American households, like electrical equipment and appliances.
Yeah, so you're right to flag that energy prices have come down and that we got to the lowest price at the pump since 2021, I think. And that's been a huge advantage to American consumers and a huge advantage to the American economy. It does drive the overall, some of the overall indices in the inflation data. But even if you take energy out and you look at core goods, as we do in our paper or at durables, you still see the same wedge. No matter how you slice the different goods data in the inflation data, there's a consistent roughly 50 to 60 basis point wedge between the price increases in domestically produced, in overall goods versus the price increases in imported goods alone. And when you annualize that 50 basis point wedge, obviously it comes to a bit more than a percentage point at an annualized rate. And so when you slice things like taking out energy or just looking at durables or whatever, you end up with different levels, but the wedge between overall goods and imported goods remains. So the conclusion continues to hold.
So I also want to ask about the central bank here. The president himself has been very, very vocal for the desire for lower rates. He has said just recently on Truth Social that 3 points is too high, and he's talking about the interest costs that are embedded with higher interest rates, which of course is a good point when you do have interest costs about to reach $1 trillion or more pretty soon. But at the same time, he has been very critical of the Fed. I want to read you this note from Neil Dutta over at Renaissance Macro. He's basically saying here that the pressure that the president is putting on the Fed is making it so that any future nominee has to be beholden to what the president is saying. What Neil Dutta said is Trump has created a litmus test for his Fed nominee. They have to agree to cut rates. If Trump picks someone close to his orbit, that person will look like a complete toady, and I'm quoting the research, and have a limited ability to persuade colleagues to a dovish position. At some point here, is the president's weighing in on central bank policy counterproductive for what should otherwise have been an independent central bank?
Thanks. So, look, I'm a huge fan of Neil, and I get along great, but I don't agree on this point. I don't think that at the end of the day anything matters but what the policy rate is. I think, sort of sitting around talking about, about optics and committee, sort of internal committee discussions doesn't really matter. What matters is what the policy rate is and what markets expect the policy rate to be. And if they expect the policy rate to be better for the economy, then we'll have better economic outcomes, and markets will welcome that. If the policy rate is set in a way that's not better for the economy, then we'll have worse economic outcomes, and markets will reflect that. I think the rest of it is just chatter. What matters is policy being set well, or is it being set poorly?
Stephen, can I ask about just the basics of raising revenue? What do you expect from tariff revenue, say, over the next 3 or 4 years, since that's what's left in this term? And what about golden visa revenue? I heard Howard Lutnick saying that you've got 75,000 applicants or queries, and at $5 million apiece, that would be like $375 billion, massive amounts of revenue. If you could, can you repeat that every year and bring in like at least $250 billion in revenue every year from selling visas?
Thanks. So I expect the tariff revenue to be substantial. And in the research we put out about the deficit implications of the One Big Beautiful Bill and the rest of the administration's policies, tariff revenue played a substantial role in thinking about where the deficit would go in future years. We had about $3 trillion over a decade from it, which works out to obviously about $300 billion a year. And that's pretty close to where CBO ended up to when CBO got around to scoring it. So that's a number that I think is a reasonable baseline expectation. Given tariff rates are going a little bit higher now, the number might actually be a bit higher than that. So, I think it's such a fantastic thing to raise money from tariffs that are ultimately, the incidence of which is ultimately borne by the tariffed country, and use that money to finance lower marginal rates in American families and American firms to encourage more investment and more work here and encourage reshoring. I think that's just a fantastic common sense policy combination. With respect to the golden visas, I mean, look, I think that Howard has enormous demand for these things. He's created an amazing product. Howard and the president have created an amazing product. that has attracted enormous amounts of interest from foreigners abroad, and I think we're going to see that huge demand materialize. However, I think you're right to point out, I don't expect that demand to reproduce every single year. It's not going to replicate every single year. I think you'll see a big demand up front.
All right. Really interesting stuff, Stephen. Appreciate your time. White House Council of Economic Advisors Chairman Stephen Miran.